So again, today what I want to do is I want to go back to the multiple analysis and I want to add in a third multiple for EV to sales. All right, so we've already been talking about EV to EBIT and the PE ratio, so I want to do EV to sales. But before we do, I want to also get kind of current data. So I'm going to take the solution that we had on Monday for Merck, Bristol-Meyers and J&J and just make sure that it gets updated. So very quickly, if we look at Merck and Bloomberg, let's get a current WACC, which is 7.5. And a current cost of equity, which is 8.3, which is 8.2. It's time of this video, right? And these are going to be the cells that we're going to start updating. So I'm going to make them yellow, so we're clear about what we're actually changing and not changing. So this will be the model PE versus the actual PE. Okay, and same thing, this will be our EV to EBIT in the model, and this is actual EV to EBIT. So basically we'll need to get that data and get these 3 data points. And then we're going to solve for the G, so I'll make that yellow as well. All right, just want to make sure I know what I'm changing versus what I'm not changing. So to finish off Merck, the other thing I need to do, I'll get this off the EEO screen, is today their PE on 2018 is 13.55. So basically, their net income is adjusted 11,038, changed a little bit. So again, this number is going to be like 1, 2. Something like that. Okay. And for EV to EBIT, 2018 is going to be 11.68. Right? We already updated the WACC. I don't think the ROIC, long-term, and tax rate are going to change. So this is probably going to go to 1% positive on our Gs. For Bristol-Myers, let's see, WACC of 9, cost of equity 9.5. Changed slightly. Cost of equity didn't change. Okay, on the EEO, PE is 19.18, so it went up a little bit. And 2018 adjusted income 5287. It didn't change. So this is going to be like 5.3, 5.2, 5.1, close enough. And here, again, I don't think the effective tax rate's going to change. Operating ROIC is probably not going to change. We already adjusted the WACC. So basically, EV to EBIT, again, just double checking, 2018 is today 17.63 for Bristol-Myers. So that G is going to be a little higher, maybe 5.5. Nope. 5.4. Close enough. In terms of, we did the PE for that one? Yes. So J&J. $7.2 and $7.7. $7.2 didn't change. $7.7 didn't change. PE today is 17.86. Net income for 2018 adjusted is 21,508. Okay, so we're probably looking at a G 2.7. Didn't really change that much. In terms of the EV to EBIT, 2018, 15.26. So basically, what, 2.29 maybe? So that really didn't change. So I just wanted to update the data to be more current for today. Okay, explain the multiples. Now, here's the thing. The next ratio that I want to add, so I'm going to drop in here and insert a row, is EV to sales. And again, we want the second forward year, so 2018. So for J&J, 2018 EV to sales is called EV to revenue, 4.94. So they're trading at 4.94 times 2018 sales. For Bristol-Meyers, they are trading at 4.72. And for Merck, they are trading at 4.01. Okay. Now, the other thing I'm going to do is I'm going to add 3 rows here. Make it slightly smaller. So, estimated EBIT margin, also known as operating margin. Okay, and that is going to be a formula, and that comes from the book and the lecture notes. When we talked about the key value drivers, we said in the last class that enterprise value to sales or revenue, which is here, equals the estimated EBIT margin times the enterprise value to EBIT. Therefore, we already did in the valuation model, is we said that our estimated perpetuity margin pre-tax is EV to sales divided by EV to EBIT. Just kind of algebra here. So that's the point. Sitting here in plain sight, which we had already figured out, if you take our EV to sales divided by our EV to EBIT, that is the forecasted EBIT margin, operating margin in this case, for Merck, pre-tax. So here's the next thing. Estimated NOPAT or NOPLAT margin, which is the after-tax version. Well, we got a tax rate. So if I take my pre-tax margin and I multiply by 1 minus the tax rate, that would be my after-tax margin. So Merck, based on its trading multiples, is expected to have about a 34% pre-tax margin and about a 27.5% after-tax margin. And that would be the two numbers for Bristol-Meyers and J&J. Bristol-Myers about a 26.8% pre-tax margin in perpetuity and about 20.9% after-tax margin, EBIT after tax, no PAT. J&J 32.4 pre-tax, 25.6 after-tax. All right, so here's the next thing. And just write it over here. So return on investment is P over I. That's return on invested capital. P is profit, I is invested capital. Okay, put an IC here for you, just so it's here. profitability is profit divided by sales. So how do I get from P over S to P over IC? I multiply by S over IC. So if I take this times this, I get this. S's cancel out. That's just, again, simple algebra. So here's the point. Margin times productivity equals return on investment. We know the margin. We have a sense of what the ROIC is. So essentially, built into the trading multiples is an estimate of the productivity of the companies that we're doing. So this is the productivity. And that is to match what we've previously done in the ROIC tree. We said that that was invested capital divided by sales. And that's an estimate. All right, so here's the thing. If I go over here and I want to get S over IC, then what I do is I take P over S, I move it to the other side, and then I just divide. P over ROIC divided by profitability is S over IC. Okay, so that's what I'm going to do here. I know my ROIC. I know my margin after tax. So I have a sense of my productivity. Way too many decimal places, so I'll just make it 2. But that number is S over IC. And just to match up with our ROIC tree, we did IC over S, which basically means this number tells us for every dollar of invested capital, how much are we selling? And for purposes of the analysis we did before, we said, in order to sell a dollar, how much do we have to invest? So we're just going to take the reciprocal to make this IC over S. So equals 1 divided by left paren, the reciprocal. Copy, paste. So here's what we know. We now know the productivity of these 3 companies, right? Merck is at 1.37 to 1, Bristol-Meyers 0.7, J&J 0.61. What's better, higher or lower? What's more efficient, a high number or a low number? Is 1.37 better or is 0.7 better? Well, what does 1.37 say if it's IC to sales? Basically, to sell a dollar, Merck needs to invest in invested capital $1.37. To sell the same dollar Bristol-Myers, they have to spend 70 cents. To sell the same dollar J&J, they spend 61 cents in new capital. What's better, higher or lower? Lower. Lower is more productive. So that's the point. In the multiples, the trading multiples that we're observing for these companies, because, and this is pretty advanced, very few people get this far in really understanding what's going on with multiples, okay? But by doing the math and understanding the key value drivers, we actually are now not only understanding the multiples, but we're getting to the granular components, and we're essentially seeing, backing out some of the forecast data for that the market is giving. And so what the market is saying is Merck has a pretty high ROIC, 20%, which isn't bad. But here's the point. Merck has a great margin, but they have terrible productivity going forward compared to their peers. Everybody see that? Okay, so let's go ahead. Question? How do you get the formula? Which one? B2? For B2, we just take EV to sales, which is B10, and divide by EV to EBIT, which is B12, the observed numbers. That's the same thing we did in our valuation model. And then I just take 1 minus the tax rate to get to B3. And then to get invested capital sales, it's going to be the reciprocal of the other result. So, long story short, go back here. Bias. Multiples analysis traditionally involves bias, right? So here's the bias from EV to sales. You'll read it in the book. You've been taught in previous classes. Should have been. Read it in Investopedia, whatever. EV to sales is representative of margin. That's the bias. Because here's the idea. If a company has a higher profit margin, that means the more they sell, the more cash flow they make. Because all things being equal, if I sell more stuff at a higher margin, I'll generate more cash flow than somebody selling stuff at a lower margin, and I should be willing to pay more for that because I'm buying more cash flow. That's the bias to EV to sales. Does that bias hold true for Merck against BMY and J&J? Does Merck have the highest margin in the industry? Absolutely. But they have the lowest EV to sales. Now, a lot of people would dismiss this as an anomaly. And they would just say, oh, that's just an exception, doesn't make sense based on the multiples. But here's where you're going to understand things that other people don't. And this is why we're doing this analysis. So here's the thing. What I'm actually paying for is not gross cash flow. What I'm actually paying for is free cash flow, which is the cash from the profit after the reinvestment. Okay? Who has the highest margin in the industry amongst these three players? Who has the highest margin? Merck. Therefore, when they sell stuff, they make more cash. They make 34 cents. Who has the highest reinvestment in the industry? Who's reinvesting the most? Merck. That's what the productivity tells me. Merck has to reinvest twice as much as J&J and Bristol-Myers. Because for every dollar of sales, they're putting $1.37 of capital into their business. For every dollar of sales, Bristol-Myers is putting 70 cents of capital in their business. About half of Merck's. So think about this. I have a very high profit margin, but I'm reinvesting twice as much as my competitor. When I net that out, I get less free cash flow. And so therefore, when Merck sells more, even though they have a high margin, because they're reinvesting so much, the actual free cash flow that comes out of that margin is a lot lower. And therefore, I'm not going to pay more for Merck sales. Does everybody understand what I just said? Can you follow along that logic? Because a lot of people can't, and a lot of people don't. Because they would just say, oh, there's something wrong here. No, it's not wrong here. The market is actually saying that because Merck is half the productivity of their peers, that what's going to hurt their sales is that they have to spend so much reinvestment to get the sales compared to their peers. It's going to offset that high margin. So growth in sales is not going to be as valuable at Merck. They're going to trade at 4 times versus their peers at close to 5 times. So this is the other nuance. ROIC matters to EV to sales, right? Because what is ROIC? Margin reinvestment, and it's productivity, and that's the point. The bias is EV to sales is all about margin. If I make a higher margin, I will trade at a higher EV to sales. The assumption is that the productivity is probably not all that different amongst my peers. The tax rates probably aren't that different about the peers. The spreads aren't all that different amongst the peers. They're all in the same industry. But here's an example where they're not the same. Merck has half the productivity of its peers, the two on this list, and so therefore, despite that high margin, that they're actually, with a lower ROIC, they're not going to generate as much cash out of that margin, so when they sell more stuff, they're not as valuable. This is what you need to understand, and this is what you'd have to be able to explain. Questions? Because we're covering a lot of stuff. This is pretty nuanced, but hopefully you guys understand it. Yes?
Is the productivity, do you think, one of the key reasons that their growth is like so much lower than the other two current fields up there compared to
Well, let me do this. If I go back to our valuation model, the as-is that we did in our last class for Merck, is one of the tabs in that model is called ROIC drivers. This is the ROIC tree. This is the other analysis I had you do, historical ROIC analysis. What we've done is we've tied the multiples to the ROIC tree. Because in the ROIC tree, we said it was tax rate, operating margin, productivity. Well, tax rate and operating margin are basically this, the NOPAT margin. Productivity is here. Look at Merck historically. Not that the past predicts the future, but look at our trend. 1.3, 1.3, 1.2, 1.4, 1.2. All right? What is the market saying going forward? What are they using for Merck? 1.37. All right? What do we know about Merck? We know that Merck is about to launch a much bigger class of drug, Keytruda. Right? I told you that Merck, that's called large molecule versus small molecule, which means there's a different level of investment in R&D. There's a different level of investment in capability to produce injectables versus chemical pills. And if you happen to have watched TV last night, you couldn't have watched the World Series without seeing commercials for Keytruda during every break. Everybody paid attention to that. All right? But Merck right now is heavily advertising Keytruda. In fact, the other TV show is flipping on is This Is Us, right? The very tragic sob story, right? But great show. But again, same thing, advertising Keytruda. So Merck is obviously ramping up, and they're spending a lot of money, a lot of investment, right? They're still getting great margin off of it, but all that money that they're spending on investment for the drug launch at this scale to become 25% of their future sales, showing up in that productivity number. Plus, Merck has historically done a lot of acquisitions. And that's what we can also see is built into the expectation on a go-forward basis. So it's not a question of right or wrong. We're just trying to explain the multiples as the market sees them. But this is not an inconsistent productivity trend with what we've seen from Merck for the last 5 years. So what I'm telling you is Merck is just a little less productive going forward than they are right now. Flipping it around, Bristol-Meyers J&J, far more productive. And that is helping them, but they don't have the margins. Merck is going to be advantaged because when they go to scale at Keytruda, 25% of their sales are going to be at a very, very high margin level. By the way, the other reason why we're doing the multiples analysis today versus last week, let's go back and look at Merck's stock price. Why did Merck's stock price last week plummet? Let's just revisit this. This was the earnings call. And this is their stock price, right? Now, what's interesting is their stock price went from the 60s to 55, okay? So again, if I go to EEO, I can actually go to quarterly data. And if I go back a period, this is what the analysts were expecting for their September 30th call. And this is what Merck reported last week. What's interesting is revenue was kind of in line. Analysts were thinking 10.5 billion. Merck came in at 10.3, but they beat on EPS. Analysts expected $1.04. Merck came in at $1.10. Merck also beat on income. Merck also beat on EBIT slightly. And so basically, the profitability metrics were actually better. Why would their stock price tank so dramatically if they miss revenue a little bit and beat on earnings? And that was the point. During the call, everybody was excited until they got to the Q&A. And in the Q&A, basically, this is what happened. If you go back to the price, and I go back to 1 month, and then I just overlay chart content, you can see it in Bloomberg, and I put on news headlines. These are the major news events that happened around the time of the call. And you can see, that was the news headline of the day. I was looking at earlier, which one of these? Trying to find the actual headline. I was looking at it this morning. That's why I was pointing this out. But what they did is in the middle of the call, what the analysts started, oh, here it is. What the analysts started to focus on was what they called the Keytruda tactics and the delayed KN 189 study worsened their advantage. And so you can see it in BICO, where the Bloomberg analysts summarize what the other analysts were saying, and I'll read it right here. Merck's decision to delay the readout of its Keynote 189 trial, which has good chance of success, threatens its lead in first-time lung cancer for its main growth driver, Keytruda, in the face of generic pressure. Roche's 5 lung cancer trials will have potentially reported by the time 189 reports, creating uncertainty. Even Bristol-Meyers CM227 study will have reported. If you remember in the last class, we talked about how Bristol-Myers actually failed their trial last August. They were redoing the trial. So basically what the analysts figured out is that because Merck is delaying the results of their clinical trial, that Bristol-Myers reworked clinical trial plus Roche Genentech's clinical trials will actually be published and therefore potentially approved before Keytruda expands to more classes. So the challenge that Merck has is that basically because they're slower in getting the data to market, even though they beat their earnings, what the analyst said is all of your growth, you can see it here in the EEO, is coming on Keytruda. But the problem is you're now letting the competitors beat you to this market that you have the lead. You're letting them catch up and pass you. And now, instead of being the market leader, you're going to be the follower. And you have a lead. So all these sales at high margin are going to be deferred. And at the same time, they may not be as high because now we're worried that the competitors are going to be splitting the market 4 ways versus you having the market to yourself. So whether Merck intended it or not, they didn't focus in the call on the quarter and the fact that Merck is doing better. They focused completely on the fact that this big drug that's going to drive a quarter of the company's sales and all of this margin is going to be delayed. Think back to the Nucor McKinsey case that you guys did. Basically, it's the same thing as saying that the second generation steel mills in step 4, instead of waiting 5 years to come to market in 4 years. And that changes the valuation. That's what Merck is going through right now in the real world. And that's what the analysts started to focus on. And so it wasn't the earnings beat. It was the future competition, EIC, that drove down their share price. Right? And here's the point. Relative to their investment, they're not going to get as many sales. That's lower productivity, which is offsetting the growth in the margin. Lower EV to sales multiple. Again, this is very advanced analysis. The average Wall Street analyst can't even do what we're talking about. But you guys, I think, are pretty smart, so we're figuring this out. So that's the point. When we understand key value drivers and we understand what's behind them, the multiples become very explainable. This is what I expect from your group project. This is what I expect for the companies that I assign to you for homework 10. I really want you to not just do the math, I want you to explain the math and not just tell me the numbers. I want you to tell me what's behind the numbers for the companies that you're analyzing. That's what you got 5 weeks to work on. That's why I want you to start this sooner rather than later. Questions? Questions about any assumptions I made? Questions about any of the data that's on this screen? Questions about any of the things that it's actually telling us that we should be understanding? Okay, so practice. So in class practice, you can work collaboratively in class on this because your homework assignment is going to be individual, which is going to be available at the end of today. But for now, spend 30 minutes. And instead of Merck, Bristol-Meyers, J&J, Lockheed Martin, Raytheon, Northrop Grumman. Okay, you'll work together, do the same analysis, use this spreadsheet, go. And then we'll talk about it. So basically, it'll be Lockheed Martin. I'll put it up here. And I'm going to hide the answers so you don't see them. Lockheed Martin, Raytheon, Northrop Grumman. Do both tabs. Okay, about 25, 30 minutes, and then let's talk it through. Once you finish the math, start explaining why they're trading at premiums or discount. What are the major explanations for those three multiples? EV to sales, EV to EBIT, and PE, adjusted PE. Go.